Hello friends. Welcome to Cliff News Knowledge Series of Mutual Funds. What are low duration mutual funds? Low duration funds are debt funds that invest in short-term debt securities, such that the duration of the fund portfolio is between 6 to 12 months. As compared to overnight or liquid funds, low duration funds hold assets of longer maturity and or lower credit quality, therefore, they have a relatively higher interest rate risk and credit risk. To understand how low duration funds work, it is necessary first to understand the concept of duration. That is because the duration of a fund affects its investment decisions as well as the type and amount of returns earned by it. The duration of a debt fund measures how much the fund's value fluctuates in response to changes in market interest rates. Duration is also known as interest rate risk. Therefore, the higher the duration, the more volatile the fund value, and the greater its interest rate risk. Calculating duration is quite tedious and requires a complex formula and detailed data on the fund's investments. For most investors, a good thumb rule is to estimate duration based on the maturity of bonds held by the fund. Funds holding long maturity bonds have higher durations as compared to funds that hold shorter maturity bonds. If a fund increases its holdings of long-term bonds, the duration of the fund increases, as does its interest rate risk. According to SEBI rules, low-duration funds have to maintain fund duration between 6 to 12 months. This means that low-duration funds are likely to invest in short-term debt securities only. Thus, low-duration funds have relatively low interest rate risk. There are no restrictions on the type or credit quality of debt assets to be held by low-duration funds. Hence, these funds invest in a wide range of securities, including money market securities, government securities, corporate bonds, securitized debt, hybrid instruments like REITs, permitted derivatives, or other mutual fund units. Low duration funds earn through interest as well as capital gains from their debt securities. These funds boost interest earnings by holding a part of their assets in bonds with credit ratings of AA or lower, which pay relatively higher interest rates. Remember, lower rated bonds yield more but also increase the risk of default. Most low duration funds will take on some credit risk to deliver higher returns. Low duration funds also have the potential to generate capital gains. When interest rates are falling, fund managers will increase exposure to longer maturity bonds in order to push up the value of the fund. The loss of interest income from investing fresh inflows at lower interest rates will be more than made up by the gain in the capital value of existing bonds. Thus, low-duration funds use strategies based on credit risk as well as interest rate risk to generate returns. Thanks for watching. Please subscribe, share and like to our channel. Thanks again.